we've had some questions about how our cash flow forecasting works. So we're going to start with a blank slate and build up all the settings and templates that you need to have an accurate representation of your cash flow over the next 12 months. I'm going to create a new estimate from my template. I've got a cash flow estimate template here, which is quite a simple template. You can see here we have 8 cost categories with a total owner price of $660,000. You'll now see, if we were to look at the cash flow forecast, it's just a flat line starting at 0. That's because even when there's an estimate in the system, we haven't yet won that work. We only want to show cash flow forecasting for actual jobs that have had a signed contract. Now we can include a weighted pipeline sales calculation as well that's linked to our leads, and I'll show you that later. For now, we'll go into the estimate, and we're saying that this estimate has now been approved by the owner. They've signed the contract, so we're ready to create a job. Now in this instance, I'm going to create a job without using a job template to show you the difference and the benefits of setting up your job templates within the system. So this job type is fixed price, and the address I'll enter. So we look at our job budget now. We have an expected bills amount of $500,000, and we have a forecast profit of our 20% markup, and then our current forecast profit, which will change as we have variations and gains and losses. If we go to the cash flow for this job specifically, you'll see that it's not looking very accurate at this point. That's because we need to update some settings within the system and build out our job templates to make the cash flow forecast more accurate. First, we'll look at our client invoices. You can see we have no client invoices set up here. That's because we didn't use the job template. Now we can manually add our invoices and schedule them to be sent at a specific date, or if we had a schedule in the job, we could link the invoice date to a schedule item date. An invoice must be scheduled for it to have an impact on the cash flow forecast. If we go back to the cash flow, you'll now see that there's a different amount sitting in the predicted cash flow for invoices. To make this predicted cash flow more accurate, we can add some schedule items in here to show the start and end date of the project. So we'll add a schedule item at the start of the project, and then we'll add a schedule item at the end of the project. Let's put this 6 months into the future. If we go back to the cash flow forecast, it will now have automatically updated to spread the income more evenly over the duration of the project. Now, this is better, but there's still further refinements that are needed to make this accurate. If we then go to our global cash flow, you'll now see that the graph has been adjusted to reflect incoming payments and outgoing payments related to that job. You may notice here on the predicted cash flow, our first bills are predicted to be paid in March 2026, while our project actually starts in January 2026. The reason for this is because of the settings in the cash flow setup. So if we come into settings, cash flow setup, you can see the default settings that are in the system when you create your account. The payment terms for your suppliers are set to 60 days. Now, this may not be accurate, so you should update that to either 14 days or 30 days, whatever the typical number of days that your supplier gives you to pay their bills. While we're in here, let's also look at the other settings that can be edited. So the default invoice payment terms, this is the number of days that you give your clients to pay their invoices. We typically see that being 7 or 14 days. Our target markup will be used to calculate a weighted pipeline of sales, which we'll look at a bit later. You can set that to whatever you target to achieve across the business. So it might be 25% markup, it might be 30% markup. And then also you can edit, if you do cost plus work regularly, you can update the frequency that you invoice your clients for cost plus work. So now that we've adjusted this to 30 days, we should see the cash flow forecast adjust when we're expecting to pay our suppliers. So you can see here that the first bill payment has now moved into February rather than in March. So now that we've made that adjustment to our supplier terms, we can see that also reflected in the global cash flow. You can now see that the curve is now flattened out a little bit more over the duration of the job. I'm now going to archive this job so that we can start again with a blank slate. Job's archived. Our cash flow is now back to a flat line again, starting at 0. We'll now create a new estimate. It's the same estimate template that we're using. Now when we create the job, we're going to pick our cash flow single story template fixed price job, and add a job address. So because we've used the job template, our schedule is automatically set up. Now this is quite a basic schedule for this purpose, and our client invoices are set up. We have draft invoices that are from deposit all the way through to practical completion for the progress claims that you're going to send to your client. Now there is still one final thing that we need to do, which is set a scheduled date for all of these invoices. So if we go and look at the cash flow forecast for this job, you'll see that the income is spread evenly over the duration of job. That's linked to the schedule start and end date. And our bills are still spread out over the duration of the job, but we can make that more accurate. So because we don't have the client invoices scheduled, the system is evenly distributing those incoming payments over the duration of the job, looking at the start date of the schedule and the end date of the schedule. And then our bills are also spread over the duration of the job. We can refine this further by changing some settings in the system and doing some further cash flow setup. So first of all, I'm going to link each one of my progress claim invoices to a schedule item. So the deposit would be linked to schedule item start council approval, and then we hit save and schedule. You can now see that this has a predicted invoice date. The same for concrete slab. We'll link that to the schedule item end related to pour slab, and we'll save and schedule that one also. Okay, I've now linked all of my invoices to a schedule item. You can see they all now have a predicted invoice date, which is going to, when we look at the cash flow, it's going to have more accurately shown a representation of when we're going to invoice each progress claim. On the client invoicing side of things, we're much more accurate. However, we now need to align our outgoing payments as well. So this is done via the cash flow setup. So this cash flow setup should be done on your job template. To avoid you needing to do this repeatedly over and over for every job that you create, you'll link each cost category to a schedule item in your template. So we'll say that preliminaries is due when council approval is completed. Foundation site works, the bills for foundation and site works cost category would be due when the pour slab is complete. Don't forget to save each time. One thing I will note while we're here is that you can go quite granular with your cash flow setup. So you could have 50% of the appliance cost category payable upon the delivery of the appliances, and you could have the remaining 50% payable on the install of the appliances. Now, if you don't have an allocation for a cost category, or it's difficult to work out when that bill will be due, the system will just automatically evenly spread that over each month of the job duration. You can now see that our bills are much more closely aligned to when we're going to invoice our clients. You can see that there's quite a period here while we're getting council approval where there are no bills or invoices being received or paid. And you can now see at the global cash flow level a much more accurate representation of the cash that's going to flow in and out related to this project. One thing we might just show quickly here is a direct comparison of adding a variation to the job or a delay to the schedule. We'll just look at in July 2026, our cash balance is $123,500. If I go in and add a variation, let's say that the client wants to add a swimming pool. We need to create a new cost category because we don't have that in the system yet. So we're going to add a swimming pool for $80,000 with a markup of 15%, and we'll approve this variation. If we then go back to the cash flow forecast and we look at July, we now have a cash in bank predicted balance of $143,950. So that would include the markup on that pool. Again, July, we now have $143,950. If we go to the job, and again, we have some delays to the project. Let's say that timber wall and roof framing has been delayed. Our schedule automatically updates. We go back to the cash flow forecast, and July is now predicting $253,950. So because the cash flow forecast is only predicting the projects that have been won, we may have projects that are commencing in the future, and we want to show how the money coming in related to that job is truly reflected in our cash flow. So what we can do is toggle on include weighted pipeline sales. Toggling that on right now is not making any change to the cash flow forecast because we need to do some further setup for the system to be able to calculate that number. So first of all, we come to our leads. We've got one lead in estimating and one close to signing, both for $1 million contract value. We have to have an estimated construction start date and a budget set for the cash flow forecast to calculate. Additionally, we need to come into data setup and go to the sales pipeline. We need a conversion rate next to each one of our buckets within the sales pipeline. So let's say for every new lead we get, we convert 10 of those to a one project. Once we get a meeting booked, it's 20%. Estimating the project, we win 35% of these jobs. And then close to signing, we can set that as 90% and one would be 100%. So now when we go back to our cash flow forecast and we toggle on include weighted pipeline sales, you'll now see that number has jumped up. That number is a reflection of the job budget, but also taking into account the target markup you have across the business and also the standard duration for your project types. So you can come in here, perhaps these are the default settings, which is all 6 months. You may say that a single story actually takes us 8 months and a double story takes us 9 months, and that will all be automatically updated in the weighted pipeline sales calculation. I'm just going to create another job to reiterate the importance of setting up your job templates. So we create an estimate using our template again. And then we create a job using our job template. Now, because we have used the job template, our predicted cash flow forecast for this job is already much more accurate. So we already have our client invoices set up and scheduled, linked to the schedule for the progress claims. And we also have our cost categories from the original estimate linked to a schedule item to predict when we're going to pay our supplier bills. Now we're going to look at building up our overhead expenses within the system. So our cash flow forecast is now showing 2 jobs in the system, and we can toggle on our weighted pipeline sales. And then if we go to the income, it will show only the project income related to the jobs. We can then add some other income that the business receives. Let's say that you rent out half of your warehouse space. We can add from January, the frequency is monthly. The amount entered with GST is $1,100 per month. We save that. You'll now see the cash forecast has recalibrated, including that other income. When we go to the expense tab, you'll see that we have our cash outgoings related to paying our suppliers and contractors sitting in the project expenses section. We also have a BAS calculation that is linked to those project expenses. Now, we may have some wages for our overhead staff, so I'm going to add some wages in for myself as the owner of the business. My wages are going to be $80,000 annually, and then I can work out what my superannuation liability is monthly, and then work out what my pay-as-you-go withholding liability is. Start from January, and now if we go back to our cash flow forecast, we'll now see that my wages are sitting in here, as well as it's calculating superannuation liability and pay-as-you-go withholding in the quarter ended April 2026. Insurance overhead that we want to add in, so let's say public liability insurance from month January, frequency is quarterly, including GST, and we pay $2,000 per quarter. You'll now see that reflected in the cash flow forecast down here. And we want to add some other overhead expenses. So office rent from month January, and the frequency is monthly, and we pay $4,000 per month. We may also have some marketing costs. We spend some money on social media promoting our business. Let's say we're spending $2,000 per month on Instagram and Facebook ads. Start to see we have our other expenses building up down here, and they're also reflected in real time in our cash flow forecast. So then the final step to ensure that you have an accurate cash flow forecast is at the end of each month, you should go in and do a balance adjustment. Once you've reconciled all your invoices and all your bills in zero for the month, you would then look at the balance sheet and see what's the actual balance of all of my bank accounts, my cash on hand, and you would do a balance adjustment. For last month, December 2025, we actually had $100,000 in the bank. We hit save, and it'll jump up to start January 2026 with that true reflection of how much cash we had in bank, and then it predicts going forward from there.